Hello and welcome to CRT Basic to Advanced Mentorship. In this lesson, we'll be looking at the advanced market structure. The first thing that we need to understand when looking at this type of structure, it is that every turning point in the market forms a swing high or a swing low. So a swing high or a swing low, you will then find that it is a pattern that has a candle that is lower from the middle one and the other one that is lower on the other side. So you have these three candles, just like when you are looking for your CRT. So you have a CRT candle, and then you have the candle that is taking out liquidity, and then you have the distribution. So when you are looking at this pattern, you then know that if we are trading a CRT, if we are entering here, then above here, that's where we put our stop losses. So above each and every swing high, we have buy stops. So above there, you have your stop losses. So this is very important to understand. Therefore, below a swing low, you need to understand that we have sell stops, and that is liquidity right there. So the second thing that we want to talk about is that when we are bullish, we want to see swing lows form at a discount arrays or after running another swing low. That is what we want to see in the market when we are looking at this advanced market structure. And this is very important because this type of structure, it is also known as order pairing. So here in front of us, we have our advanced market structure, which it is bullish. And what we want to see when the market is bullish, we want to see price breaking the highs and rejecting the lows. So we want to see these swing highs over here being broken, and we want to see the lows being rejected by price. So the market comes below a low or a swing low, and then it rejects, and then we move high. And if you were to look between this dealing range, right, if this is your dealing range low and the dealing range high, you want to see a swing low, and that swing low, you want to see the market run below it. Our entries, we want to place ourselves within this region. Therefore, from this region, we can then buy, targeting the highs. And as the market has formed a new swing low and a swing high after breaking this high, what we are looking at, we want a swing low to be formed. It is either it is going to be on this side, or as the market is going down, we want to see a swing low that will be created, and that swing low needs to be patched. When it is being swept, we want to place ourselves within this area. And if you take a look from swing low to swing high below 50%, we want to see this happening, right? And we can position ourselves in entries and then up until we broke that high. So that is what we want to see. In this diagram on the other side, we then see the market moves high, and then we only sweep liquidity at this point, and the market then goes low, and we have this swing low over here. And after the market has swept a swing low, then the market was ready to go and break the high. And we had a swing low and a swing high that is formed, which is our dealing range. And what happened was, before the market could take out that high in a discounted area, we are looking at a swing low that has been created. The market then comes and sweep that low, and this is where we are interested to start looking for our entries to then target that high. Before the market takes out the lows, we have no entries because there's no liquidity that has been taken. So when the market takes out liquidity, then the market is ready in a discount array, then we can look for the market to start looking for those highs. Now we have a new swing low, we have a new swing high. This is our dealing range. The market is coming down, and then it creates a swing low right here. After creating a swing low, the market then takes out that swing low, sweep that swing low, reject out of it, and then we start moving higher towards our target. So when we are bullish, this is a structure that we want to see in the market, and we want to pair the orders. You want to take these orders from this area, and then you pay them with the other orders above. So we have stop orders, and then we have buy orders right there. So what we then do, we are delivering these orders to those orders, and we want to come and take other orders, and we then deliver them to those orders. We take these orders right here, we then deliver them on the other side. And when the structure is bearish, what we want to see the market pairing these orders above. We have these orders being paired with these orders below. So that is what we want to see. We see the market rejecting, collecting orders and delivering them to the opposite side. And then the market takes out orders and then deliver them to the other side, to the swing low. So you are taking orders from a swing high and then we deliver them to the swing low. So we want to see the market rejecting the highs but breaking the lows. Rejecting the highs but then breaking the lows. We then pull back with a rejection of the highs. I want to see a swing low being broken. So if you look at this, you have a high, the market makes a low, then pulls back. We then take out this low, and we then pull back. The market comes and take out a swing low, right? Now we have a dealing range from that high to this low. Within this dealing range, we are looking for swing highs. We have a swing high right here, and we have another swing high right there, and we have another swing high right there, right? So when the market is pulling back, we are hunting for these swings. And what then happens is that above these highs, we are looking for another swing high to happen. If we are bullish, we are looking for a swing low to form. If we are bearish, we're looking for a swing high to form. So this is where your CRT normally forms above other swing highs. So when the market gets into this area, we have a swing high, therefore our CRT formed in that area, which is our swing high also. Then from the fourth candle, you were looking for the sells up until that, or the 50% of the candle, or you were targeting those lows. So a swing high is formed. We then break the low, forming a swing low. The market is pulling back. We have these equal highs over here, and that is where we are looking for the market to take out liquidity. We need to pair this liquidity with the below liquidity. Therefore, when the market gets into these equal highs, we are aiming, or we're anticipating that a swing high will form, or our CRT will form in that area. When the market takes out those highs, we are anticipating another swing high to form. Within that area, we then look for sells up until that low, or the 50%, or the swing low itself. And then as the market was going low, you can see that the market was taking out other highs to pair it with lows, right? The market pulls back with a swing low over here, then runs below. We then come back. We also take out those highs and then we drop. But now with a swing high over here with a swing low, we then wait for the market to pull back to premium areas, and then we'll then look at these highs having stop losses, right? If I was taking the CRT setup, I would put my stop loss there and the market would drop. If I took this one, my stop loss is here, the market dropped. If you are still holding on to those trades and you didn't collapse them, when the market comes to collect liquidity, you are stopped out, and then you form part of that liquidity that needs to be delivered below. So this is where we actually look for our best entries above previous swing highs, and then we are expecting that another swing high forms. As you can see, we have a high, we have a low here. Probably the market then created another low here, right? Another candle there. And then we also have another form of market that we work with within this market. It is called a consolidation market. And in this market, you then see that the market is stuck within a range, within a swing low and a swing high. And this market is ranging inside that. And we want to avoid such a market. We don't want to trade such a market, but the concept still works. As this market is dropping, what you will then see that what fuels the market to drop most of the time, it is liquidity that is formed above swing highs. You have relative equal highs, which is a swing high and another swing high. For the market to drop here, it had to take out that swing high, right, in order to drop. But in order to go and take out that liquidity, we had to take out a swing low two swing lows, which is relative equal lows. And what you will then discover is that when this liquidity was taken out, it was paid with that liquidity. And when this liquidity was taken, we wanted to pay it with this liquidity over here. And eventually the market takes out this liquidity, and as it is going up, this liquidity was paid with the liquidity which was there. And before the market came to this swing low, the market had to pay this liquidity, right, above those highs with this liquidity. And before the market can take out that high, the market had to pay the liquidity below here. It was taken, and the market starts to move high, pulls back, and eventually the market takes out this liquidity over here and this liquidity over here. And what then happens, the process repeats within that area. Liquidity is being paid with the below liquidity, right? So the market will take out that liquidity and it will drop it to the next liquidity. But then from that low, what would happen? The market needs liquidity to move. So we have that area that has liquidity, right? The market will pay this liquidity with that liquidity, right? And from that area, what will then happen? We have that area as an area which has liquidity, and then we have this area as an area that has a liquidity. So we have a swing low with a swing high. So the market will oftenly take liquidity from swing highs and drop it to swing lows, and that will be the cycle. But if you want to trade, let's just say, because I'm saying we need to avoid this type of market profile. If you want to trade this, I would trade this at the extreme highs. So when the market reaches this low, I'll be looking for buys. When the market takes out this low, a lot of people will see this as a breakout and they will want to pump in sells. But what will then happen, this is a manipulation, the market will then drop, and then I'm looking for my buys, targeting the liquidity inside here and eventually above. What the market would usually do would take out the liquidity below and then go back to the 50% of the range. So I'll take a trade from this area, target my 50% of the range, or go up until there. All right. But normally I'll just go up to 50% because you'll never know what the market will do. All right. So if I was looking to trade this type of market, I would look for the market to go above my dealing range high and dealing range low. That area, that is where I'll be looking to sell above and buy below that range, right? So that is how I would trade this. So let us go to the charts and see some of this playing out. We are going to take a look at our examples. We're looking at volatility 100. This is the 4-hour chart. So we're going to look at our basic structure, combining it with our advanced structure. And then what we are going to do, we're going to map the structure. We took out a low right here. Therefore, we have a dealing range of high and low. From that dealing range, we then combine this dealing range with our advanced market structure. What do we want to see? We want to see above 50%. We want to look for swing highs that the market needs to take liquidity from. Therefore, above the 50%, we then draw our line, right? That will delineate our liquidity that needs to be taken. And as the market is going there, you then see that the market goes above the 50%, come and takes out our swing high right there, and then our market drops, right? If you to take a look, this low, it is then broken there. And then we then have our new dealing range from that high to this low, right? So we have a basic market structure. And then from that basic market structure, after this low is broken, above 50%, we're looking for swing highs that the market needs to take. We have these swing highs after 50%. The market makes equal highs. And then now we have a strong area. Within this area, we have another swing high above that swing high, relatively equal highs. Therefore, the market then comes and takes out these highs above 50%, and then it starts to drop. And then we then look at the market from that point in view, and then the market then closes below that low. Now we have a new dealing range in terms of our market structure, And then what we are then looking for, above 50%, we want to see swing highs. So we have swing highs above 50%. And then what we are looking for, we're looking for the market to go above those swing highs, above 50%. Then we'll start looking for our entries to come to the lows, because remember, orders need to be paired so that they might be delivered to the other side. So if these orders are not paired above 50%, we have nothing on our hands. So the market is really not ready to move. So from that point, when the market broke this low, we had a new dealing range between that high and this low. And what we were looking at these above 50%. We have all these swing highs above here. And what we are looking at, we are looking for the market to come into this area, then give us something so that we might target the low, which is weak. But what then happens is that our strong high was then broken, changing a direction right there. Therefore, from that point on, we had that high, because this was a minor pullback. We have this high and we had that low on this pair, right? And we are looking for the market to come below 50%. Then we have a swing low right there. That's what we have. But also above 50%, we also have another swing low. And the market decided to take out this swing low, create another swing low inside a fair value gap just above our 50%, and the market started moving higher. We then had a new dealing range from this low to that high. And then probably you might ask, why not this high? Why not this high? But what you will see is that this high was swept by these highs, and then I then extended my high to that high. And the market swept this high, not close above it, then I extended my high to that high. And the market dropped, came back, closed above that high. Then I had a market structure break right there. Therefore, that is why you will then see this low as my point of anchor, and that one creating a dealing range. Below 50%, I have this swing lows. I also have this swing lows and that swing low. And then this is a strong part where I don't want to see the market closing below. So what then happened is that the market came to the extreme lows and didn't take out these lows over here. The market then came, take out our swing lows within this area, created a new swing low within this area. We started moving high, going to those highs. So I would then take this from this low to that high. What I'm looking at below 50%, actually from this low to that high, we're looking for a closure above these highs. So what we have a dealing range. After the market takes out these lows, take out the high with this candle, we have a new dealing range. I'm looking below 50%. I'm looking for a swing low. So I have these swing lows over here, a lot of them. And I'm looking for the market to come within this area, give me another new swing low, then we can start looking for the market going higher. This low, I'm not expecting it to be broken. Therefore, what happened? The market then came into these areas, give us our swing low in this area, then we started buying. The market came back into that area, went above, and then collected liquidity above that swing high, and then it broke below this low, right? Our strong low. Then right there and there, we then changed trends. From there, with that high as a swing high and this low as a swing low. Now we have a dealing range, and then we're looking for the market above 50% with a swing high. Above that swing high, that's where we're looking for our entries to go short. Let us look at one more example. This is the Nasdaq, and we'll look at our basic market structure, combine that with our advanced market structure to get trades. So you'll see that we have a dealing range low, a dealing range high, and below 50%. We take out liquidity, and then we start looking for trades going higher. And the market follows suits, takes out that high with a dealing range low, to dealing range high, and then the market didn't come below 50%, but it took out liquidity above that 50% and we move higher. Right? There are reasons why the market didn't come here, or which we are not teaching that at the moment, but let's continue. The market then takes out a low, takes out a high. Now we have a dealing range low, a dealing range high. We have liquidity, which your swing low, the market takes out that low below 50%, then we move high. We take out that high, we have a dealing range low, dealing range high. The market takes out a swing low right there, just above 50%, and the market pushes higher, taking out that high. Within this area, you can see that there was liquidity that was being taken, took out liquidity, we then move high, came back, took out liquidity, then we took out that high. Then with the dealing range high and low, the market came and smashed that. And what we were looking for, this was a market structure shift telling us the market was bearish. And we were looking for the market not to go above this breaker block. We're looking for the market to pull back into the breaker block and then drop. Therefore, there was a dealing range high to dealing range low. The market retrace above 50%, created swing highs. So we then have three drives pattern, 1, 2, 3, and we didn't close above the 50% of the breaker block. That is what we wanted. Then we could have traded this, targeting these lows, right, and eventually those lows. So we order paired there, got out of there, and we bagged the money. And when the market came and closed above this breaker block, we knew that the market has changed direction, because this PDRA, they are not supposed to be violated. Where they swing low, swing high, and then we had that low as a place where we have liquidity into a fair value gap. The market then takes liquidity out of that and then created a new swing low within a key level, and then the market went high, targeting these highs, and it moved. This week, we were looking for the market to then come now fair value gap and then push higher. But then what happened is the market opened with the gap and then it moved higher. So we have this swing low, and that swing low is one of the targets, where if the market takes out this low, and then we look for the market to come and take out that high. So that is what we are looking at this moment. So this is what you look for when you are looking and mapping your advanced market structure. The market needs to pair liquidity, take it from somewhere and take it to the opposite side always.